Hello everybody, so welcome to this video. This video is a Patreon first video and it's the Q&A, the first Q&A I ever do on the channel. So all of these questions are from Patreon and you left me your questions, and as you saw, I've stopped taking questions for this round of videos. I'll make another post in a few weeks where you can ask more questions. Today, I am only going to cover 7 of your questions, and we'll get to them in a sec. And I'll make another video later this week probably where I will cover another 6 questions. I'll do another video Q&A next time. So if your question is not answered in this one, it will be in the next one, okay? So let me get started with today's first Q&A, your top questions answered, and I am getting started with the first question. If I had to start all over with $10,000 today, how would I allocate it across assets? And you know, it's an interesting exercise. It's an exercise where I'm going to assume I'm 25 again. So for me, that was 11 years ago, 25. I don't know how old my average viewer is. Actually, my average viewer is between 35 and 45 is the highest number of viewers. But I do have a lot of Gen Z, and I love Gen Z. And I mean, clearly, right? Half my investments are with Gen Z. So I love it. So I love this question. So let me go ahead and ask you and tell you what I would do all over again. So if I'm 25, tomorrow I wake up, I'm 25, and I have $10,000. Well, there's multiple questions to ask. So in your early 20s, one key question that used to be an assumption for the longest time was the college/university question. I realize it's a little off topic, but not exactly, because a diploma, right, is a form of asset. It's a form of an asset that's going to help you to have higher earnings in theory, but in theory alone. So on the question of the college and university question, I would say if you're going to college for knowledge, I would not go to college for knowledge. I would use YouTube, Audible, X, podcast, wherever you learn. I know there's a whole array of videos on TikTok which are actually fairly smart and that are all about learning. You know, we're also too quick to dismiss TikTok. I've never used it, but I know some people learn stuff on TikTok. So I don't want to dismiss any social media. But if you were to invest that money for college, I would definitely consider YouTube, Audible, all of these resources. You know, Reddit even, the amount of stuff you can learn on X or on Reddit, just learn there. Now, if you're interested in having a licensed job, on the other hand, then I would still go to college. And what do I mean by a licensed job? Well, if you want to make the big bucks as a physician, you need a license to heal. And that license to heal is given to you after, 11 or 12 years of studies, right? So you from 18 to 30, and then you get a license, and then you can make $300,000 a year or something like that, at least in the US. I don't know how much they make outside of the US. Nurse, right? That's a much quicker journey, but a nurse, you need your good 4 years, and you're going to have to be with college. Even if you want to do any of the licensed jobs in the business world, like CPA or dentist, not business, of course, but there's many jobs where you need a license. And if you're interested in having a job where you need a license, then college still makes sense in my view. And then the last point of the college question is if you want to switch countries. So that's what I did. I had no choice. I was an undergraduate student in my early 20s in the US, and I stayed up until the PhD because I knew it was easier to get a job and get a visa, especially get a green card. If you don't have a PhD, getting a green card in the US it takes forever. It's nearly impossible. So I knew that I had to have a PhD to do that. If you want to immigrate to a new country, and of course, if you are foreign born like me, I'm French born, French raised, and I came to the US in my early 20s, and then I got all of my paperwork, my green card. I'm a citizen in 6 months here. If you are in that scenario, college is going to be pretty much your only way to do it, aside from marriage. But even marriage, like they will check so much now for US immigration. I think you don't have a choice. So if you want to have a licensed job, if you've always dreamed of being a physician, an MD, you really don't have a choice. You have to go to college. If you want to switch countries via labor and work, you really don't have a choice. You have to go to college. So spending money on college in that case, I think, is a fair investment. Now, spending it for just knowledge and just knowing stuff for the sake of knowing stuff, I would go YouTube, Audible, X all the way is how I would recommend learning. No advice ever on this channel, as you know. But now that I've gotten the college question out of the way, which is an early 20s question, now that I've gotten that question out of the way, let me ask you another question. If you're young and you're just starting out, and like I said, we're working with $10,000. So we're working, I'm just going to assume the question is like we're working with less than $100,000. I'm going to assume, right? So the housing question. And this is something I wish I could have done, but unfortunately I moved here too early, so I couldn't do that. But live for free for the housing question, right? Is living for free, living with your parents. Okay, maybe it's annoying a time or two, but it's amazing. Because you don't pay rent. So imagine. I mean, you can have a very low-paying job if you live with your parents, and you can invest that money. And so if you get along with your parents and your parents have a big house, in your early 20s, I really personally don't see a single problem with that. You could live with a sibling, with a brother, a sister. You could even be creative. There's a whole community online of people who are very creative. They turn like old FedEx van into apartments or something, like a mini studio or a mini apartment, and they just park it in the parents' backyard, and they just live there. If you can handle that, if you're that personality type, living for free. So when it comes to the housing question, nothing beats living for free. When you are 25 or under, you can do that. Another way, if you don't want to live with family or use family resources, another way to do it is just to live in a cheap studio. And this is where you're going to have a challenge in the US because it annoys me so much. I can't find anything for rent less than 900 square foot. Problem of living with Texas, but I know that in France, in Europe, I'm going to extend that to Europe, but I know, an 18 square meter studio, you can rent that, right? You can rent that, and it's going to be very, very cheap. And if you can afford to do that, well, that's so cheap, and the extra money beyond your rent, you invest it. Very, very obvious, right? Another one is have a roommate, rent a room, and another one is to even the whole idea of a life hack, go to Asia, right? That's maybe a stereotype a little bit of a digital nomad, but there's plenty of ways where you can live on the cheap. You can live on the cheap by doing geographical arbitrage, right? You just because you can get a really nice villa or a really nice house somewhere in Indonesia or something for dirt cheap, and so you can do this arbitrage, quite a bit, and so maybe that could be an option if you have an online job or an online career or an online ambition. Okay, that's the housing question, and these are really out of the box thinking, doing it for free, or near free, or very cheap. And I think a more, do I want to call it mainstream? I mean, there's nothing mainstream about my channel, but a more, a more solid idea, I would argue, is to do this. And some people would never want to do this because they don't want to move away and far from family. But I think a more solid idea, and this is what I did, by the way. So of course I'm going to be biased, but I think a solid idea is you move to a low cost living area, and you spend your cash on a fixer upper, on which you're going to pay it cash, and then you're going to be saving your rent. You're going to be able to have minimum insurance, the highest deductible possible, like really your minimum insurance that you can have. You're going to be able to get away with that. And you just pay your property tax with a county, and you don't have a mortgage. And so this is not possible where I am at now in Texas, right? It's not possible. If you live in a neighborhood where Most of the houses are, just under a million or a little more than a million, depending on. You can't do that. And that's true for Texas. That's true for New Jersey. That's true for California. That is true for any big city in Europe, right? Paris, France. What are you gonna do if you? I mean, it's so expensive. So unfortunately, the young want to live in a busy city with all of the bells and whistles and everything that is happening there. But it's not a wise financial choice. I guess I'm sounding like Dave Ramsey. I know this is Dave Ramsey's big thing. Oh, you should move to a low-cost living area. But I really believe that if you move to a low-cost living area when you're 25, think about what you can get if you're willing to do that. And of course, if you live in the US, the airports, it's all everywhere. I mean, you can fly back as often as you want. You can fly back, really. So what I did is, personally, I was living in the Midwest, from age 21 to age 29. I was living in the Midwest. I bought a house. My house was $33,000 and it was a fixer-upper, and I fixed it up. And come age 30, 29, how old was I when I sold that house? I was like 30 or 29 when I sold the house. I sold it for 96, bought it for 33, and you put it. You know how you do that money? Elbow grease. You fix it up yourself. And you can learn everything on YouTube. It is so easy. You can learn everything on YouTube. And you can do it on YouTube, and it's easy to fix up yourself. And when you're young, when you're 25, what you have is you have a lot of energy. You have a lot of energy to learn, a lot of energy to move. This is, in my view, the ideal time to get a fixer-upper. Don't get a dump, but get something, slightly less than decent, and turn it into something slightly more than decent. This is, of course, no advice, but I'm not showing you the cities here, but I just went in random cities in Ohio and random cities in Pennsylvania, for example, for the US. This is a really nice house. I looked at the inside. It's a little fixer-upper. There's a few things to fix up, but it's not nearly as bad as you'd think, $45,000. I looked up at this one. This one is. Oh, I guess you can look where it is. There you go. I forgot to remove that. There you go. That's in Titusville, Pennsylvania. I have no idea where that is. I zoomed randomly on Zillow. This is very nice. I mean, for $15,000. Like, think about that. Think about that. And this is the inside. So if you look at this house right here, this is the inside. I mean, frankly, this. I mean, if you're, this seems to be like just an abandoned project. What I'm trying to say is that these houses are not total teardown, right? With elbow grease, with work, you can fix up a house like that, and you can learn to do it. And it's just a great way to save money. It's a great way to make money when you are young, when you're 25, when you have that energy. And I realize it's a pretty US-centric point of view. You're going to tell me if you're in Europe, oh, you can't do that in Europe. Well, so in Italy, for example, they had advertised this €1 house program for the longest time, but I think it came with many caveats and many things. I'm showing you just a random region in France. So this is in the Ardèche region, which is like very, very popular. Lots of tourists over there. Anyways, I don't know if you can see. This is a €49,000 house. You can see it's a house inside a village, right? 100 square meters, so 1,000 square foot, 5 rooms. I mean, this is the rooms. It looks outdated. It looks like it's from the 60s, but you can redo the flooring. Anybody can redo the flooring. Anybody can remove the wallpaper and paint the wallpaper. Like it's, you can update the door. You can make this look very nice. Go to IKEA. Look at like kitchens at IKEA. They're the easiest thing in the world to set up. You could make a place like this and really make it look nice. Here's another example, another random example. You see this house, old French house. What is it? €35,000. So, and I know not half. What is it? 45% of my viewers are from Europe. You can do that in Europe too. It's just a matter of you're not going to live in Paris, or you're not going to live in I don't know, in Rome or in Madrid. You're going to be living in the country. But you can absolutely do that in Europe. And to me, that is a great way to save money, save on rent, and you can save that money and invest it into the stock market. And let me get thus to the crux of this question, which I assume was you've answered the college question. You've answered the housing question. And notice how I don't give you cheesy answers. Like when you see this type of videos, they'll give you the cheesy answer, oh, the best thing you can do is invest in yourself. Concrete stuff, right? The college question, do you need college or not? That's point number one. If you don't want to be in licensed profession, I really don't think you do. Question number two is the housing question. Are you the type of person who's okay living with your parents until you're 27, 28? Or are you the kind of person who's okay just hopping from city to city in Asia and just living online, having an online job, doing some drop shipping, some Instagram, whatever you want to call it, and you just live from place to place? Are you that type of person? Or are you not? And if you're not, then I recommend moving to a low cost of living region and fixing something up and learning how to fix things up. Nobody's born handy. You can learn it. It's really not that hard. If you've been able to assemble IKEA furniture ever, you can, paint and do all that sort of stuff. So let's assume you've answered this question. Then you have $10,000 left. Where do you invest? So again, not trying to give you some basic answers. If I was in these shoes and I had $10,000 and I've answered the college question and I've answered the housing question, I would not invest if I had not answered these two questions. But once you've answered these two questions, I have $10,000 left. Then what do I do? Well, I would probably try to go for a multi-bagger, right? I sympathize with the capital preservation school of thought, but I think it is starting to make sense for me as I'm closer to 40, right? It makes, in my view, if you're 25, capital preservation, you have a lifetime to make the money. If you lose that money, you have a lifetime to make it again. So this is no financial advice. This is just me. But I would consider a multi-bagger. I would consider something with a little leverage, right? And by leverage here, I mean leaps. So for example, and leverage, I don't necessarily mean because oftentimes people think you mean leverage, they think, he's saying you should take a crazy amount of risk. No. This is not what I'm saying. I'm saying if you have the soul of a stock picker, which I think a lot of the people on my channel have the soul of a stock picker, there's a lot of undervalued stocks that could pop that I like right now. I mean, I cover HIMS and LifeMD in the channel. These are just two that come to mind right now. There's many more. While I'm perfectly fine entering LifeMD and HIMS mostly for common stock, because I'm not in a hurry or anything, I wouldn't fault anybody considering leaps, and there's ways to do options safely. You do leaps. You do them at the money. The stock trades at $20. You buy a call, a right to buy the shares at $20 in 2027, and you'll see. Maybe you'll have a very positive surprise. And if it works out, if you've picked the right stock, if leaps work out, you have a beautiful upside, and the downside is really limited because unless you're shorting a stock, like only shorting a stock gives you unlimited downside, right? If you lose the option, you lose the option. That's in my view, that's a nice way to increase the return with taking reasonable amount of risk. You're buying the right to buy. You're buying the right to buy a stock you really like 2.5 to 3 years from now. And hopefully 200 years to 3 years from now, you have the money, you can exercise the option, and you can buy the stock. You exercise the option, you buy the stock, and you reduce your cost basis, and you don't have a taxable event. And it's I like it a lot. Now, of course, I've been pounding the table on Tesla and Bitcoin for more than 2 years on this channel. They've popped so fast with the U.S. election. Will there be some mean reversion? I don't know. I mean, I really don't know. But Tesla, like in my view, if Tesla was to get under 300, I would be adding back to Tesla. Bitcoin, my position in Bitcoin is very full, so I wouldn't be adding to Bitcoin right now. I'm just riding with what I have. But there's some stocks that are still cheap and I haven't popped. And I make regular videos on this channel about the stocks that I haven't popped, that have not popped. If you are not a stock picker, though, my go-to, and this is kind of like FIRE, financial independence, retire early movement. They're all about index funds. This is kind of like that, but on steroid. And there's two versions of that steroid. It's the TQQQ or the QQQ, no financial advice. And this is a situation where I think people should think for themselves. In the accounts where I have indices, where I have a choice, I have TQQQ because I moved away from the leverage bad analysis and I actually look at the data. I look at TQQQ since 2010 and how it's performed. And yeah, it's not a perfect 3x, but it's also not a 1x, right? It's also not a 1x. It adds volatility to the index. And over the long run, in my view, I love TQQQ very much. And that's why there's so much asset under management under TQQQ. But of course, let me tell you one thing. TQQQ is not designed to be held more than one day. It's a product that is not designed to be held more than one day. It's kind of like a bank. When I look at the banks, a company is not designed to not go bankrupt when it has negative equity. You're not supposed. I remember. Was it Credit Suisse? Was it a year and a half ago? You're not supposed to have a company keep running and having hundreds of thousands of employees and having customers who still have money when it's $500 billion in the hole. That's not supposed to happen. But that's not first principles thinking. So first principle thinking is does it work? And a lot of people have caught on TQQQ actually working. And sure, you have tremendous upsides and downside with TQQQ. Sure, buying TQQQ right now is not nearly as good of a deal as buying TQQQ when it was at the valley of despair point in 2022. You want to be careful with these leveraged assets. But if you're a very long-term shareholder, in my view, for me, no financial advice, but for me, it has worked tremendously. And so if you go back and you do your return calculator from 2010 to 2024, you're at 18,000%, an average of 42%. So that's 183 times your money. You put 10,000 and you get 1.8 million from 2010 to 2024. Again, think for yourself. Will it keep doing that? Well, that's a big question that you have to ask yourself. Look at the top 10 stocks in the index. Would you buy Nvidia right now? Would you buy Apple right now? Microsoft, Google? The problem with TQQQ, I guess, is that's Costco, and I don't really like Costco in it. But otherwise, Apple, I guess, is a little overvalued. I don't think Nvidia is overvalued. I think Nvidia is fairly valued given the opportunity. I definitely don't think Google's overvalued. Meta is overvalued. I don't think any of that. Visa and MasterCard, I wouldn't own Visa and MasterCard outright. They're too slow, too boring. But they're also cash machine, absolute cash machine. They generate so much. Their EBITDA margin, I cover it sometimes. I'm flabbergasted by how high. So again, it's all about thinking for yourself. If you want to do a deep dive on the indices, figure it out. Look at S&P 500, look at TQQQ, and look at QQQ, and decide for yourself. That's all I have to say about that. Okay, now let's talk about over cryptos. So I had a question about, why do I choose Bitcoin over cryptos as an inflation hedge? Is it just because it was the first mover? Are there any other coins that I would like, right? So let's talk about this. So over cryptos, I'm not a Bitcoin maxi, although I greatly sympathize with them. I think they get a lot more right than they do get wrong. But I'm not a maximalist. I like to think I'm pragmatic, and so I look at over cryptos, and so there's two over cryptos that I own. It's Dogecoin and it's Solana. So let's talk about Dogecoin before people entirely dismiss what I have to say here. Dogecoin is the top meme coin, period. Meme coin are a type of coin. They're a type of new asset class that's gonna exist in the digital finance space that doesn't exist in the current space, or maybe in the form of collectibles that you get at a pawn shop of some kind, like Pokemon cards or whatever. It exists in the physical world. We're just really unaware of it. In the digital world, I think we're going to have a new form of these collectibles, this fungible art. That's why I took the example of a Pokemon card, or what is it? There's another game that people pay a lot of money for. Was it Magic the Gathering or something like that? Anyways, doesn't matter. It's a form of fungible art that I think is going to exist in a digital form, and the top digital form of that fungible art is Dogecoin. Gen Z loves that stuff. Gen Z loves Dogecoin. They love meme coins. Like I said, it's the digital Pokemon card. Is all the way. It's the only way I can say it. And Dogecoin, of course, it's linked to Elon Musk. It's linked to X.com, and it's linked to popular culture. So you have a lot of upside derived from the value of the celebrity of Musk and the like. And people get hung up when they look at the Dogecoin and they say, oh, well, it's got an unlimited supply. Well, yeah, it has an unlimited supply, but it also is not a type of supply that can get out of hand like gold and, of course, like fiat. That's point number one. And then point number two is the yearly inflation of Dogecoin is actually not really that high. So you can see it's in the 3-ish %. But as more Dogecoin is issued, as we move to 2030s, the 2040s, you're going to see we're going to be closer to a 2%, a 1% yearly inflation, new supply of Bitcoin. So in the algorithm, in the script algorithm of Dogecoin, you have actually some restraint. And if we fast forward to, say, the year 2200, that percentage will be so low, it will be essentially the same as a fixed cap. And so even though it doesn't stop at 21 million exactly like Dogecoin, it's going to get to a point where the curve is essentially, the curve of new supply is essentially going to be flat, right? And so if you have 1 billion Dogecoin, and you have many more than that, of course, but you're gonna have it essentially be flat. And another way to think about it is think if Dogecoin was trading at $1, right? Well, you would have 153 billion dollars worth of Dogecoin, and then in 2050 you would have 278 billion dollars worth of Dogecoin. The dollar is trading at $1. According to the dollar in the US financial system, M2, there's $21 trillion in the US financial system right now. How many trillions of dollars do you think there will be in the US financial system in 2050? Is it going to be double? If it's double, that's not as good as Dogecoin. Dogecoin's not going to double, right? And in 2050, of course, if you follow that stuff, it's going to be way more than double. So even though there's no cap to Dogecoin, I think the market is really, really quick to dismiss it. And that's why some may say you may get some value plays in that space, in the Dogecoin and meme coin space. But I think it's inferior to Bitcoin. I definitely do think it's inferior to Bitcoin. We are not talking about the same thing. But to me, I have a little bit of it. It's play. It's mostly play. And by the way, I never calculated it, but Dogecoin might actually be my best investment ever. Because I bought it for fractions of a penny. I think I acquired something in 2018 or something like that. I never sold it. Fractions of a penny. Like, I don't know if it was 1/20th of a penny or something like that, but something super, super low. So anyway, Solana. Let's talk about Solana. So that's fun. That's Gen Z love that stuff, and I love Gen Z, so we're good. That's Dogecoin. Let's talk about Solana. So Solana is a different story. Solana is a serious blockchain. It's got a lot of usage. It's got a lot of Web3 apps that are being built on top of Solana. And the only thing I have to say is I recommend you get the Phantom wallet and you try out Solana for yourself. Try it out for yourself and see some of the innovation happening in finance. I don't have a lot of spare time, unfortunately, but I did a deep dive on Radium, on the liquidity provider tokens, on farming. You can go to, say, a website like Staking Rewards too, somewhat similar on how to earn yield. It's a rabbit hole. And I specialize in stocks. But sometimes I go and I take a peek into this rabbit hole, and I get amazed by some of the innovations that we're going to have on a blockchain like Solana, right? And Ethereum, I was looking at Ethereum the other day. Yeah, it turns out the gas fees on Ethereum are not nearly as high as they used to be. But I think it's too late, because in my view, when I look at Ethereum, I remember the 2020, 2021 days where the gas fees on Ethereum were something totally ridiculous, like $90 or $100 to make a transaction. And, I've dismissed Ethereum because of that. And Ethereum, like a lot of people, are still very pro-Ethereum because that is where a lot of the stable coins are run. But they're working on stable coins on Solana. I am amazed by that future financial system that's going to happen. In my view, the future of finance is going to be handled by a variety of blockchain, a handful. I think there's going to be less than 10. I don't think we're going to have thousands of blockchains, but there's going to be a few blockchains, no doubt in my mind. And is Ethereum, is Solana, are they going to be part of that story? I think so. Absolutely. Especially because, keep in mind, whether it's the Solana blockchain or the Ethereum blockchain or any other blockchain for that matter, you can wrap Bitcoin and list Bitcoin on it and do your transactions with Bitcoin as the financial part. And once you've wrapped the Bitcoin, then you can do your trading, you can do your buying, etc., etc. Fascinating field, fascinating world. I wish I had more time in my life to dig into that. I really, really do. And by the way, linking it back to Gen Z, this is where Gen Z, this is where the 25-year-old can shine. Because if the 25-year-old doesn't want to spend time fixing up a house, they could be in Bali, Indonesia, renting a room for $400 and then really understanding the crypto stuff and understanding that stuff and picking it up in the financial systems of the future. So I see a lot of hope in that sector. Also worth mentioning, blockchains could also be a serious way to make money, not necessarily in the form of earning a return on your investment, but simply in the form of earning airdrops and governance tokens. And you may know that in these apps, a lot of these blockchains, they work very much like a mutual, right? If you're a mutual, it's the customer who owns the bank, in a way. The customer owns the bank. Well, in the case of many of these apps, the ownership belongs on the user. So if you take an example like Facebook, so Facebook, who owns Facebook? It's a shareholder that owns Facebook. The user doesn't own anything, right? In a Web3 app, the user and the owner are often one and the same. Which means that if you are an early supporter of a project and you use the project a lot, you're going to get tokens from that project. And you can make money like that. You can make money by being a user of the project. Think about how this is entirely reversed, how the economics are entirely reversed. Web 3.0 applications may very well be owned by their users from the get-go. And the older you've used the app, the more of the app you own. This is how it could work. And so very hopeful if you're just getting started out. I wish I had more time. I want more time. Moving on. CleanSpark. So one of you has asked me, thank you for a question, by the way, what's going on? Why has CleanSpark really not done very well compared to, mostly MicroStrategy, right? Well, it's because CleanSpark is being heavily shorted. That's why they were halted last Friday, because they had too many shorts on it. I think the stock is very undervalued, as much as some people are trying to arbitrage and make money from the short. I think it's a very stupid thing to do, because this stock could squeeze. You could have a short squeeze. How much money do they make right now? Is it something like 50,000 per Bitcoin? Probably something like that. I think you asked me a question about the dilution. I think the market does not understand the dilution for a miner like it does for MicroStrategy. For MicroStrategy, the market understands dilution right away because Saylor dilutes the stock and then he announces that he's bought the Bitcoin. You have a 3-day time frame between the moment the stock is issued and the moment the Bitcoin is acquired. Miners, unfortunately, they don't have the power of that announcement because they dilute to expand. They dilute to buy more miners, they dilute to buy more land, and they dilute to buy electricity. And once the miners, land, and electricity, the hardware miners, the equipment, the electronic equipment to mine, the computers, mining computers, electricity and land, you put them together, you operate them, and once you do that, you mine Bitcoin. And the Bitcoin, you make it in a hodl bag. So miners are very tough to understand for traditional Wall Street, especially if they just hodl the Bitcoin and don't really ever realize a gain on it. But in my view, I agree with CleanSpark, and I agree that it's the more tax efficient way to do it. You issue common shares or debt. With that debt, you buy the rigs, you buy the electricity, then you mine the Bitcoin, and then you hodl the Bitcoin. And it's much more tax efficient than selling your Bitcoin at a profit in order to pay for your operations. At least that is what I think on that one. Now, moving on to an important question that you've asked me, which is borrowing against Bitcoin, borrowing against the shares. So many of you seem to not see this as a reality, and because this is something that becomes obvious and becomes real once you start dealing with those business circles, right, and those stock trading circles. So as I often say, yes, my plan is eventually to borrow against the shares, borrow against these assets. Famous that Mark Zuckerberg in the early days, he bought against Facebook stock. He had billions of dollars of Facebook stock and he pledged some of it in order to buy a $30 million house. You have $5 billion of Facebook stock. You borrow $30 million against your Facebook stock. Yes, it's risky. Yeah, it's leverage. And yes, if $5 billion become $30 million, you're in trouble. But what are the odds of that happening? Right, and borrowing against shares is a very powerful way so many entrepreneurs have succeeded. Think about Elon Musk buying Twitter. To buy Twitter, Elon Musk pledged a whole bunch of Tesla stock and a whole bunch of Tesla shares. So again, this philosophy of borrowing against stocks. It's good to make a headline that is scary. People are going to make scary headlines. Oh, you're going to get margin calls, right? There's even a movie called Margin Call. It's good to create a scare. It's good to appear highly virtuous and say, oh, I would never borrow against my stock. I would never do that. Well, guess what? If you have money at a bank, the bank did that on your behalf, and the bank is probably insolvent to begin with. So the government does that. So it's easy to virtue signal and say, oh, I would never use margin. I would never do this. I would never do that. Yeah, you want to be very careful with margin. You want to be very careful with borrowing against your assets. You want to do it in a wise way. You want to understand what mark to market means, right? Mark to market is if there is very high volatility in your portfolio, if your stock could drop 90% for just a few hours, then you would be liquidated. That's the whole idea of a liquidation and the mark to market. So you want to be very mindful as to whether you're leveraged on a mark to market basis. And if you do that on a mark to market basis, you want to make sure you have a huge, enormous margin of safety. But borrowing money to buy a house, for example, you're not mark to market if you do that. And even if you pledge, and okay, we're going to talk about that in a second. Let me just finish about stocks, borrowing against stocks. So borrowing against stocks, well, you have two ways to do it, right? Well, because money is fungible. So if you buy some of your portfolio on margin, it's essentially the same as putting less into your portfolio, and you can keep that cash for other purposes. So since money is fungible, really using margin to buy more stock, or using the initial amount of money that you had initially intended to buy stock, that's the same thing. So margin on your brokerage account is a proxy for borrowing money elsewhere on the personal account. So that's point number one. But nonetheless, back in the day, right, before we had Robinhood, and before we had any of these modern traders who lend money on margin for dirt cheap, back in the day, we had this thing called a pledged asset line. And so a pledged asset line, this is a Schwab thing, for example, where you could pledge some of your stocks, and then they would give you a very low interest rates, probably the lowest interest rate you can get, and you would borrow against your stock with a very, very low interest rate. It was called a pledged asset line. Nowadays, if you use it, and because Schwab, by the way, still has insane margin rates, all of the traditional brokers, except interactive brokers, has good margin rates. But Schwab still has nosebleed margin rates, and most of them have nosebleed margin rates. Robinhood doesn't, right? Robinhood has a very inexpensive margin rate. So if you were to borrow against your stock in, say, the form of a Robinhood, you wouldn't be going through a pledged asset line and actually going through a process of, I'm going to borrow money and invest it in real estate or anything like that. In my view, I view these two things as the same thing. You borrow money against an asset that you have. To understand how it works, you have to understand the Federal Reserve Regulation T, Reg T, which means that if you want to buy $2,000 worth of stock, you can put $1,000 out and you can borrow $1,000 against the $2,000 of stock, because the bank has virtually no risk, because if your $2,000 worth of stock start dropping too fast, they will issue you a margin call, and if you don't have a margin call, you will be liquidated and they will get their money back. So it's quote unquote low risk for the bank to lend you money, i.e. create money, right? Because that's what they do. It's very low business for them to create money against your stock, create money against your stock that you have on your account. And the stock serves as the collateral for the loan. It's a little similar to a mortgage with a lien on your house. The main difference, though, between borrowing against a stock and borrowing against a mortgage is that borrowing against a stock, it's 50%. It's way, 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 way less leverage than borrowing to buy a house. Like if this scares you, getting a mortgage should scare you much more, because mortgages are so leveraged. But people don't have problems getting mortgages because mortgages are not mark to market, right? You're not going to get the loan is not going to get called. It's not mark to market. So that's one aspect here. But let's talk about buying volatile assets. If you buy volatile asset on margin, it means that you're going to have higher danger, because you may be borrowing too much on your margin. So typically we say be wise with the margin. Don't borrow too much against your margin account. It is less danger though if you say borrow, say if you have $1,000 and you borrow 50 against that $1,000, your stock needs to drop by 95% for you to be in trouble. So it's a little less risky, a little less danger. Another reason why I say borrowing against your stock and within reason, right? Within the reason of not exposing yourself to too much risk, is borrowed money is not taxed, right? If you borrow money, you intend to pay it back, right? So it's not taxed. So that's the point I'm trying to make here. Okay, another question. This question is about my position size, and you tell me you say, oh yeah, why are you in 1% position? Is that a distraction? Or is that a low conviction play? What's this? And so if you've stayed this long in this video, for when I post it on YouTube, this is what I share on my Patreon. On my Patreon, I have a long list with all of the stocks that I have access to. And by the way, this only shows down to 1%, but you can see I have other colors here on the chart. These are much smaller stocks that I own. I have many stocks where I have less than 1% exposure. And so this Patreon member asked me, well, why do you do that? Why do you do that? It's isn't that pointless? And I kind of agree. I agree. It's a distraction. I agree. It's a little. I mean, because when you look at my portfolio, Tesla, Bitcoin, growth stock ETF, so TQQQ and QQQ, and then HIMS. So HIMS is still a very large position. If HIMS were to hurt, if HIMS were to go down, I would be hurt. But then you have a good 20%, which is just a bunch of tiny positions. And essentially, the point I'm trying to make, I'll get to these points here. The point I'm trying to make is that let's assume I perform in line with a QQQ. At the end of the day, managing all of this will end up being kind of like a growth ETF and QQQ. I'm hoping I can do a better job than the QQQ on many of these stocks. I have done a better job than the QQQ, right? Palantir, it's 1% of my portfolio. I didn't put 1% of my portfolio in Palantir. It earned that spot. It was a micro position that grew quite a bit. So it's a distraction to have a bunch of small positions. But this distraction is on purpose, because this distraction, it avoids me sitting for 1 year doing nothing but wonder what I should do about the Tesla and the Bitcoin position. I don't ask myself every day what I should do with my Bitcoin and my Tesla position, because I have full conviction in it. And I am focused on the hobby, really. I mean, it's really the hobby part of the business, managing the tiny positions. That's the hobby. Like, I can't seriously say that me investing a teeny tiny bit of money in that stock or that other stock is not a hobby. That is a hobby. Me focusing on that hobby is done in such a way that I don't mess up the big position. I've always been an advocate of never messing up the big position. And the reason, this is something that I've learned from Ben Graham. Ben Graham, this book is very outdated on a lot of stuff. Very much outdated. Like the cigar butts investing, anyways. There's a few stocks where it's not outdated, though. One of them is the investor needs to find something, because they have the itch. They have the itch to do something. We have the itch to tweak the stocks. We have the itch to be cute and sell the stock for a quick profit and trying to buy back in. We have this itch to do something. And if you love stocks, and if you buy individual stocks, you're likely to love stocks. Don't forget, this has been a hobby for centuries, right? So if you love that and if that's your hobby, you'll want to play the game. You'll want to be buying. And so I deal with my itch to buy by managing this tiny position portfolio, this tiny position, following others, reading on stocks, having the YouTube channel. That's the reading part. But then I deal with it by opening tracker positions. So I sometimes I buy just one share to follow the stock. So I have a lot of teeny tiny tracker positions that really don't matter much, that I don't even include in that spreadsheet because they're too tiny. And I literally DCA on most days. I like to think that I bought the best stock of the day, or the best relative deal of the day. So on most day, I will do a little DCA, and it's very small, and it's my monthly DCA sum, whatever amount I've allocated monthly for that year, each month, and I divide it by 20. And I invest. And even if you deal with very small sums, nothing today with zero fee brokers, nothing prevents you from just putting $10 a day. I mean, that would be low, but nothing prevents you from putting whatever sum a day. It's all about the itch. It's all about dealing with the itch. Nothing prevents you from doing that. We've reached this era where small buys or micro buys are possible, and that, I think, has a very psychological effect, where you're always doing something, you're always tweaking the portfolio, but you're tweaking the positions that are tiny, that are not as consequential. The consequential positions, they are the cornerstones of your portfolio, and you don't really touch them that much. It would probably be best to do nothing and sit for 20 years and not look at stocks again and run away. But I don't think the way I do it is going to hurt too much, because I hope, that's my hope, and that's what I've witnessed, is roughly going to be in line with a QQQ. If I'm roughly in line with a QQQ on my 20-ish stocks that I play with, that I add, that are tiny positions. If I'm roughly in line with QQQ, it's really, you can look at just 3 buckets of my portfolio, or 4 buckets with HIMS, right? That's kind of the way I look at it. And let me conclude with recession stocks and hedging. Interesting question here. So, do you think that by buying high quality companies at decent valuations, one is likely to do well or protect themselves in case of a huge crisis like a 1929 crisis? Do I believe in hedging a portfolio by adding gold? So let me tackle the question of gold for first. Then I'll tackle what is a high quality company, and then we'll talk about 1929 style crisis and whether they're even going to be a thing in the future. So anyways, so gold versus Bitcoin. I think that's a fair question. Bitcoin is my big position. I believe in Bitcoin as my edge, but I also think gold is fine, but I don't think gold will do as well as Bitcoin. I want to say this. Gold people and Bitcoin people, they should like each other. They really agree on 80% of the stuff. I think this tension between Bitcoin maxis and gold maxis is really, manufactured by the modern day of social media and Peter Schiff, that I blame a little bit for this tension. All of the gold versus Bitcoin debate is in them, and it's like why is there a debate when you gold people, the libertarians, they agree on the foundation. The foundation for store of value, the whole part of gold, of gold and the money supply, the inception or the celebration of gold as an hedge, as an asset, that inception is the same. It's as though you had written a book on money, and the first 8 chapters on the book of money were about gold, and the last 2 chapters were about Bitcoin. So gold is scarce. It takes a lot of energy to mine gold and get gold out of the ground, and that's why gold can't really be printed. Bitcoin is an improvement upon gold because you can know how much Bitcoin there is out there. You can't know how much gold there is out there precisely. It's an estimate, right? So that's point number 1. And point number 2, gold, you still have the issue that when the price of gold goes up, there's more people than mine gold. The supply of gold increases and the price of gold goes down. Granted, it's hard to mine gold, so it takes years and years, and it takes hard work. But if the price of gold was 30,000 an ounce, we'd find a bunch of gold real quick, and you'd have new mines opening up everywhere. If Bitcoin is $1 million, it doesn't matter if there's 10, 20, 30 times more miners. They will not find more Bitcoin because the issuance is pre-scheduled. That being said, gold has something that Bitcoin doesn't have. It's tangible. And it's very popular among some people. Gold has a dual ornamental purpose, right? Gold is a store of value, but it's also ornamental. Does gold trade much higher than its ornamental value? Most likely, it certainly does. But let's say if you buy jewelry for whoever, right, and you want to buy jewelry, one way to look at jewelry that's made out of gold, for example, is a stealth family investment. It's a stealth family investment. So if I were to buy gold, or let's say if I had to buy jewelry for somebody or something, well, maybe my playbook would be minimum diamonds, because diamonds have manufactured scarcity. Minimum craftsmanship, because how do you value craftsmanship? I don't really know. And then maximum gold. Not jewelry advice, but that's what I would do. I would try to buy a jewelry that has a maximum amount of gold and a minimum amount of craftsmanship and a minimum amount of gemstone. If you've ever seen like a I think it's Cuban. I think it's a Cuban jewelry chains, like Cuban gold chains. Yeah, perhaps that would be my jewelry. I don't know. I don't really do jewelry, but otherwise not jewelry advice. But yeah, you want to maximize the gold, and if it's in the form of jewelry that you have to buy anyways, might as well buy the gold. You know, I would choose that over any other form of jewelry. You can also do old coins. Some people like that. If you have old coins or rare coins, you can sell them back to museums. But gold will underperform Bitcoin in my view. It may keep up with the S&P 500, however, depending on how fast we print. But in my view, it's gonna underperform Bitcoin. But you know, I much prefer gold over bonds, for example. I mean, I prefer just about everything over bonds, just about everything. So, anyways, how about high quality companies? So let's answer this question. So this Patreon member asked me about high quality companies, and I agree that as a store of value, a high quality company is a good idea, but it depends what. If it's a high quality tech company, absolutely. If it's a Costco or JP Morgan, I'm like absolutely not. I mean Costco. Whenever I go to Costco, it's you know, 100 people just standing around. Absolutely not. And same for JP Morgan. I can't even look at the balance sheet. And yeah, it's too big to fail. Yeah, the government is there to help, and it's going to be too big to fail. But, you know, the government also has to deal with debt ceiling every 2 years. So anyways, but if you're going to buy a high quality company, I think the way to do it is, sure, maybe it's going to be slower growth, but you want to make sure that it's highly profitable. You want to make sure that it has low debt. You want to make sure that it has a low number of employees. And these firms could be a good edge, you know. So an example of a stock for me that would qualify for all of this would be Google. Google, in my view, or even Amazon. I could put Amazon, Google or Amazon in there. You know, they're slower growth tech companies, but they are highly profitable, low debt, you know, not too many employees, although Amazon has a lot of warehouse employees. So Google, let's just go with Google. Google would qualify as this, in my view. Very high quality company, very few employees, very profitable, right? It would qualify for that, in my view. And I would use EBITDA. Just look at EBITDA for valuation, not earnings, because earnings are subject to all sorts of accounting opinions, which you don't have as much as EBITDA. EBITDA, you just include back everything and you look at what, in my view, is the best proxy for cash flow. And let me conclude this video with 1929 style crisis. So are we going to have another crisis like 1929? Well, the answer to that is I don't know. In my view, we could if government got virtuous again, and if they stopped the cycle of spending, you know. But otherwise, I think the world has shown over and over again that we are not willing to go through depressions like 1929 again, and because of that, they will print. They will print the money. The money printer will go burr. And so I expect that if we were to face another 1929 style situation, you know, you would have an emergency Fed meeting, and then the Fed would start buying ETFs and start buying stocks and all that sort of stuff, and send helicopter money and bailout money to households. It seems to me like the world doesn't want to go through the pain of 1929, and they're willing to kill the dollar. Nations are willing to kill their currency just in order to not go through this style of recession. So that's also something to consider. I may be wrong. This is not financial advice. Next video, I will have all of these questions in next video. It's coming. Anyways, let me conclude by saying again, this is not financial advice, not investment advice, just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you for watching, and have a wonderful, wonderful day.